Good morning, everybody. This is Patrick MontesDeOca with live trading talk for March 30th, 2022. Taking a look at the headlines here regarding the Russian invasion of Ukraine, it appears that Russia is basically negotiating to drastically reduce its military activity near Kyiv. The question is basically, is Russia deploying the troops somewhere else? Is this a real peace talk or simply Russia manipulating to strategize a better position and basically increase the pressure in the areas that are basically being invaded, particularly the areas of some of the separatists regions that want to stay with Russia? So this basically is a positive shift in the geopolitical situation between Russia and Ukraine. And I wanted to take a look at just to see what the fundamentals are, not necessarily that these are indicators to trade with, but this is the general news that is out there. One of the things that I'm looking at basically is the inflation rate that is running at 7.9%. It hit a fresh 40-year high. And these are the indicators that the government basically is telling us. Now, some of my indicators, or you might say sources, like shadowstats.com uses the formula that was used in the 80s regarding inflation, and inflation is running more like 15%, including the old formula. And it's being exacerbated by the Russia and Ukraine crisis that has essentially eliminated the production of commodities. The Ukraine is called, in that area, is called basically the bread basket of Europe. Major wheat producer. They produce approximately 25 to 30% to the world in terms of production. And it has completely thrown the commodity markets for a loop, which has caused, again, some issues here with regards to the supply situation. It's not a bottleneck situation. Now it's a production reduction of about 25%. So it's causing a tremendous volatility for energy prices, for commodity prices. And the real question is basically, how long is this going to last, right? In my estimation, I don't believe that inflation is going to go away anytime soon, particularly with this situation here in terms of the production in Europe, commodities, energies, natural gas, crude oil, particularly as we move into the winter times. One of the issues that is being discussed right now regarding Russia is that Russia possibly demanding payment in rubles for the commodities. They want to support their currency. And if you want to trade with China, you got to pay in rubles. And or potentially what we're moving into is rubles or gold. So we have a number of different black swans that are now coming in and affecting the world inflation rate to levels that are unprecedented, and it's causing a lot of pressure for consumers, not only for consumers but also for companies, businesses that are experiencing a dilemma of whether their profits will increase or they have to pass that along. Decrease. Will their profits decrease, their balance sheets, or they'll have to pass this increase, which is literally across the board of inflationary prices to the consumer. And obviously, we're beginning to see in the consumer area also a lot of pressure, wage pressure. And so inflation is going to be pretty ingrained, you might say, in our system right now, particularly as the market itself is beginning to dictate interest rates without the Feds having to do anything. We're looking at the 10-year note at 241, and it's not too far from the 2-year note. We're looking at the 10-year note at about 240 and a half. The 30-year is at 253.6, and the 30-year is at 253.6, and the 2-year is at 237. If you take a look at the 2 and 10-year note, it is almost inverting. We're a few basis points from inverting, which means basically that the 2-year note is going to rise higher than the 10-year note. And if we run higher rates than the 30-year bond, I think it's pretty much the market indicating that recession is right around the corner. So let's take a look at, for a minute, the difference that we're talking about in terms of why the discrepancy or the indicator is telling us that potentially this indicates a recession. When you're looking at inflation rate according to the Feds, just according to the Feds and their formulas, it's running at about 8%. And if the 2-year note is roughly about 240%, you're looking at a negative yield on the US dollar of about 5.5% to 6%. If you factor in the real inflation, which is running at about 15% according to shadow stats, you're looking at a huge negative yield of about what? 12.5%. And this is a serious gap that we have on the spread. The inversion potentially is going to cause a crunch on the credit swaps, as we did back in 2008. And the cost of financing, the cost of money increasing under an environment which is extremely leveraged to the gilt. We have a $30 trillion debt bubble building, and interest rates are skyrocketing. I wanted to put together all these elements, my friend, because all of these elements here are indicating potentially an explosive move in gold, an explosive move in silver, as we see that basically the world is going to be looking for a safety haven that they can go into, and it's not the US dollar when you're taking a look at all of these fundamentals, all of these indicators that I just pointed out to you. We're running about a negative yield on the US dollar of about 10%. And any dollar denominated asset obviously is being devalued silently by that much. So you tell me, how long do you want to hold an asset with a negative yield of 10% on an annual basis, which could get worse? So what I'm pointing out to you now is basically the current situation that is different than the 1970s. And in the 1970s, when people compare inflation, the U.S. debt was about $800 billion. And we're looking at a 10-to-1 on the debt, over the last 50 years, obviously. And inflation, pretty much was subdued by the ability that interest rates went up to almost 19%. So in order for this gap to adjust, what has to happen is that either inflation, that gap, the inflation rate has to come down, has to narrow from 8% to 2.5%, or interest rates, in order just to offset inflation, has to go up to about, what are we talking about? If it's 8% inflation rate right now, it's got to go up to about at least 9%. So we're looking at about a 6.5% increase in interest rates, which is impossible to have under $30 trillion debt, my friends. Just do the math. It's basic math. And this is what's hanging over our heads right now in the U.S., in the U.S. dollar, in addition to the possibility that if we do go into another recession, that the government is going to have to pump, as they say, more stimulus. And this is what they're afraid of. Or is it intentional that they allowed inflation to run wild as it is in order to reduce the interest payments that they have to make on the $30 trillion debt. Once again, this reminds me of Mexico in 1981. Point in case, Mexico was about to default on their loan payments to the United States. It was a very critical situation because in the U.S., obviously, we were running inflation at interest rates at 19%, and basically, it was the highest inflation rate that we experienced at the time. And it broke the back of Mexico. Mexico could not pay the debt in US dollars. So what they did is they devalued their currency from 16 pesos to the dollar, and literally overnight, it went to 46 pesos to the dollar. And hyperinflation set into the economy, and the peso went to thousands of pesos to the dollar. And that is basically the currency that they were using to pay the interest payments, as opposed to a diversification away from the US dollar into a basket of currencies. People that were in the know made fortunes within 2 weeks when they nationalized the banks. They restricted capital outflow, and inflation went through the roof. Same thing happened in Venezuela. The difference is that in Venezuela, obviously, it is a different political format than Mexico. So our currencies imploding, you might say, as we print endless amounts of fiat currency, which is really what is happening. This has been accelerated tremendously by this Russian-Ukraine crisis. It has ended globalization, and protectionism might be the new word in the street coming back. China has entered into discussions with Russia about using the yuan as the world's reserve currency, as the petrodollar, the new US petrodollar. And that is a significant shift in monetary policy that essentially could be devastating for the US economy, for the US dollar, as I believe it will bring us into hyperinflation and become another third world country. These are historic times, my friends, and this is also a great opportunity to use this crisis as an opportunity to change your life, to change your net worth, to take advantage of the change in the paradigm, you might say, that is occurring into this new world order that is occurring, which is basically shifting the control of the US dollar as the world's reserve currency, and also the euro dollar. Are we in the beginning of seeing the yuan as the world's reserve currency? That's on the table right now. And it's a question of what Russia and Saudi Arabia decide to do at this point. And I believe sincerely that this is the major reason why we have a war going on here. It's about crude oil. It's about the control of energy prices globally. And I believe that as a consequence of the weakness, you might say, of the Western powers, the Western economies, the political nonsense that we've seen has given China and Russia the opportunity to take control. And one of the ways that they're doing that is by purchasing gold tremendously. And obviously my question is, will China, if it becomes the US dollar, the US world's reserve currency, will it be backed by gold or silver in some way? Will gold take once again a position in the monetary system as some form of basically getting back to the dollar, to the gold standard? Great opportunity to take advantage of gold and silver, as I'm doing here, as we basically are using this information for us to trade the market short term, build basically the liquidity to invest long term. These are tremendous opportunities, and the more volatility that we have here, how we take advantage is by basically applying the variable change in price momentum indicator that you see here. These are lines coming into the market here as far as the trading is concerned today. We already basically closed out our swing positions here in silver and capitalized about $4,635 on the trade. We are neutral. We are waiting now for another signal here to be activated. And basically, we're waiting patiently for the trigger points, which will be a close about 24.89 on this close. Using the 15-minute bar, we have activated a buy trigger from 24.89 at about 3 a.m. this morning on the Globex. And the targets that we have for the silver are 25.35 to 25. This is the daily target of 25.35, and 25.53 is the weekly target. So what I'm doing here is basically, in terms of trading the markets, I'm using these fundamentals to make sense of what's going on the big picture, and in trading using the variable changing price momentum indicator to give me high probability signals that are basically a combination of about 4 or 5 different metrics that go into a filter that produces this very simplistic model, but very effective model. And basically, the standard deviation that we use in the principle of the reversion to the mean produces and identifies trades here with 90-95% probabilities. And so, it gives you the ability for you to have that on your side when you're making the decision, as opposed to trading of the seat of your pants and not at least using the math of the market to enter or to exit a position. We have some real interesting times, and we want to use this once again to add to our long-term metals in gold and silver We are maintaining a long position in Bitcoin. And obviously, we're watching very, very carefully here the relationship of the yield curve inverting in terms of what is that going to do to capital flows. I believe we're going to see a massive move to metals as a flight to safety once the perception sees out there that we are accelerating and collapsing in the US dollar purchasing power. Let's continue to watch these events very carefully here and continue to communicate with us here. Like and subscribe. The trading room will be open for the remainder of the trading session for the day. If you have any interest in joining us, please let us know. In the meantime, my friends, I will speak to you later. Have a great trading day, and we'll talk to you soon.